Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week. And we're going over Broadcom Semiconductor, and it's up over 900% over the past 5 years. Folks, that's almost 200% a year. And we're looking at VMware, which was a company that Broadcom bought some years ago. And remember, folks, if you want to live on this beach like Jimmy Buffett used to, then you've got to learn how to invest even better than Warren Buffett does now. And let's go over Broadcom. Well, it's a technology conglomerate formerly known as Avago. That's how it got its stock symbol, which originated as a semiconductor company in the beginning. Now, it designs, develops, and supplies a range of analog, mixed signal, and digital semiconductor devices, which is 58% of last year's revenues. And it's acquired numerous software. And folks, this is how this company is growing. It acquired numerous software companies, which are now represent 42% of revenues, and including CA back in 2018, Symantec, VMware, that's the picture you just saw in our introductory video, and as well as a storage company, LSI, and networking equipment, Brocade, employs approximately 37,000 people. Now, folks, I just want to let you know that we did a report on this about almost exactly a year ago, and it had half as many people, actually 20,000 people that it was employing. Now it's employing almost double that amount of people. And let's look at the quick stock analysis. We are looking at the clean surplus ROE, and we are comparing Broadcom to the average stock in the S&P 500. And the clean surplus ROE, I want you to think of as your bank account. Would you rather put your money in a bank that is giving you 13.5% or one that's giving you 46% like Broadcom is? Okay, no question there. Now, let's look at the net income. Average stock brings in about 13% a year increase in income, and we are looking at Broadcom with 62%. Folks, that's astronomical. When it comes to revenue, yeah, you've got to have revenue that comes to the bottom line, or else you're not going to bring anything to the bottom line, and it is 2.5 times that of the average stock out there. Now, one thing I want to show you is that when you see a company whose net income is something like 62% and it's bringing in 17% revenue, that means, or revenue growth, that means that it has a big markup on its products. So it is in the right kind of business, folks. So those semiconductors that it's making and those companies that it bought are bringing a lot of profit to the bottom line, and there it is right there. And when we look at the net income a little bit closer, we can see how this company has built up that net income, little hiccup in 2024, and we can see that it is just growing. Now look at 2022, because that was when we had a downturn in the market, and 2020, which was COVID, remember that? Barely a blip in the decrease in the net income in a year that nobody was allowed to talk to anybody else unless you had a mask on. But look at this growth in here. And remember, to get into our growth portfolio, we want to see stocks that have a clean surplus ROE of 20% or better. And since 2021, this stock has been 20% or better, with the exception of this hiccup in 2024. But look at these returns in here, folks. This is astronomical. Retention rate this coming year is expected to be 60%, which means that it's putting more and more money back into itself in order to grow. How do we know that it's growing efficiently? Because the clean surplus return on equity is going up. What does this mean when the return on equity goes up? It means that it is increasing its earnings at an accelerating rate. That's very, very important. So when you see this ROE going up, and here's a 3-year, 5-year, and 10-year, when you see that ROE going up, it means this company is growing at an accelerating rate. Very, very important. Years to pay debt, 2.3 years. And this is Buffett's rule. He says if a company takes all the money it's making and puts it back into itself in order to pay off debt, how many years will it take? His rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. So this company actually fits into our scenario very, very Well, years to pay debt, only 2.3. So in other words, it is generating enough money, more than enough money, in order to make the acquisitions and the improvements in the processing of semiconductor that it does. So this stock is firing on all eight cylinders, folks. And when we look at 1 year, we see with the market up about 13%, this stock is up 97.89%, almost 100%. And again, the S&P up 13%. So you can see that even this year, it is doing very, very well. Nice climb in here. This was absolutely, what a great rally during this market. And when we look at 5 years, just absolutely astronomical. So we can see that even in 2022, we can see that as the market went down, and the market's the black line, this stock also went down, but it started coming back before the market did. So it barely broke a sweat during 2022. I mean, it went down for a while, but it came back and ended the year almost where it started. And while the market lost about 19% for the S&P and 34% for the NASDAQ. So this stock did not have the hiccup that the NASDAQ didn't even have the hiccup that the stock market itself, and I'm talking about the S&P 500 did. So that's one reason we like this stock. I don't want to call it a defensive stock, but boy, oh boy, it sure acted very, very well in 2022, and it has been going crazy to the upside all this time. And of course, in the beginning of 2025, we had this hiccup when we started talking about tariffs, and everything just sold off. And then from there, it's been straight up. So very, very good stock. Now, I want to show you something here. Each year in our ETF letter, we take top 5, 6, or 7 stocks from each of the ETFs. So this is part of the ETF analysis. And we started in 2019. We backtested at the beginning of 2019 to 2015, and we don't have that here because it's testing. And then each year, including 2019, all the way up to 2025, this is as of last week, we took the top stocks, here we are over here, the top stocks from the semiconductor ETF, and we use the XSD as our semiconductor ETF. We took the top 5 to 7 stocks each year, and you can see that with the market, this is the S&P 500, the market up, you would have made 164% compounded, which is very good, by the way. If you took the XSD, the ETF itself, you would have made 393%, almost 400%. So the XSD, the ETF semiconductor, very, very, very nice. But if you took the top stocks that we select each year, you would have been up over 1,000%. And these numbers are as of last week. So you can see that the top stocks we pick using the clean surplus methodology can do very, very well for you. And we just want to show you in here that it's not without risk, because the S&P went down 19%, 19.5%. The XSD itself went down 31.7%, but don't forget the NASDAQ was down 34%. So the semiconductor ETF itself did actually better than the NASDAQ index back in 2022. Our top stocks were down 42%, so there's your risk in there. But if you're willing to take that risk and just use a part of your portfolio to pick these 5 or 6 stocks a year by following our ETF letter, you would be up over 1,000% in the past. We're looking at almost 7 years now. We're into November right now, and by the end of December, it'll be exactly 7 years. We're up over 1,000%. Very, very nice, folks. So remember, if you want to live on this beach like Jimmy Buffett used to live, you've got to learn how to invest even better than Warren Buffett does now. So folks, we had a tough week this week, but all is good in our semiconductor ETF and the stocks in our 30 stock growth portfolio. So you go out, you clear your head a little bit, use some of that money you made, and take your wife out or your husband out to lunch and maybe have Sunday dinner with the family. Most of all, you stay safe, and we'll see you right back here in a couple of days.